Alright guys, welcome back to the channel. We're in for a treat today because I've got a friend of mine, Anthony Cheung. Thanks for coming on, Anthony.
Yeah, you're welcome, good to see you.
Anthony Cheung is a fundamental analyst, and we thought it'd be really cool to give you guys some insights on the world of fundamentals, because it's not often talked about, is it?
No.
It's not the most,
No.
it's it's kind of underground when it comes to retail trading particularly, although having said that, many people do ask the questions, you know, shouldn't we be paying attention to news? Shouldn't we be paying attention to what's going on in Iran and the coronavirus and all the rest of it? So we're going to talk a bit about that today, and it's going to be a fun lesson. We're going to cover a lot of ground. And at the end of this video, we're going to do a bit of a Q&A, which is live as well, for some of the questions we got in on social media today. So really cool video. But first of all, I want to just kind of talk a little bit about the history of trading in general. Like we were talking earlier about the evolution of how easy it was and how it's progressed and how it's advanced over the years.
Yeah.
Tell us a little bit about what you've seen over the years.
Yeah, I mean, from talking about it from my point of view, which is the news and fundamentals, so things have changed dramatically from 2006 was when I started. So back then, how news was disseminated was that literally the newspaper hard copy print would come out that morning. We would read it literally at 5:30, 6 a.m. in the morning, and we would make decisions then on the news that was available then about what might drive markets for the open that day. Big difference to now, which is obviously the news is 24/7.
Yeah.
I mean, markets are kind of open, you know, barring Saturday, markets are open from Sunday night till late on Friday night. So now when something happens, wherever it is in the world, so say like you mentioned Iran, if there is a military strike on a US airbase in Iraq, all of a sudden you know about that literally as it happens.
Yep.
And so markets can be incredibly responsive to that nowadays, and you overlay then trading systems like algorithmic trading or high frequency trading, these types of things. It's a completely different landscape now to what it was then. So I think from a retail trader's point of view, it is harder now.
Much
I
harder,
would say.
right? It was very easy. It was almost easy back then, eh?
It was definitely. I remember, so a good story I was told. This was before I started on the analyst desk, and so in Bishopsgate in Liverpool Street, there used to be an office in a firm called Refco, where it was one of the biggest broker in the world, New York-based company. Their London office where my brother used to work, and the story was that you could go downstairs, get a pasty from the pie shop at the bottom of the train station, Liverpool Street. You'd get a little beeper on your pager. So we're talking back in the late 90s now. Yeah. You had enough time to scoff your pasty, run upstairs, jump on the mic, say the information on the news. Markets would then respond because no one's actually aware of it until you say it and you broadcast it. And so you had like a latency of like 2 minutes or something. Whereas now my job was to find, certainly my previous role when I was fully accountable for relaying information in real time, 3 seconds I would be reprimanded. Not only from any superior, but from traders.
Right.
They would demand immediate information. And so it's kind of like, and this is what I think traders find hard to understand. They're kind of, well, you know, imagine yourself being in a trade every second of every hour. You know how you feel generally. You can't switch that off because at any moment, anything in the world could happen. And so that could move markets. And yeah, it was not for the faint-hearted.
So definitely not. So I can appreciate how hard it must be stepping into the role of a squawker, an analyst, because you've got a lot on your shoulders.
Yeah, I mean traders are demanding people.
Yeah, right.
When you are right and you help them, they don't thank you. But when they think you're wrong and they've made a mistake,
it's all your
money,
fault.
It's all my fault.
Totally.
Of course. So, but there was I guess a little bit of an understanding with that between, I would say, in a bigger firm sense, between the people, my guys, and say the traders, which was that it's a necessary thing. I don't think having confrontation with someone, as long as it's done in a relative controlled way, is a bad thing.
No.
I think it can be quite efficient in terms of people. You know, if someone needs to give you critical feedback, I'd rather know about it and act upon it, rather than, you know, what can happen in a normal workplace. I think trading is quite unique in a trading floor sense.
Completely, yeah.
Because,
completely different. Yeah,
people. Otherwise, you have to like, okay, I'd like to send an email to the HR manager, and we'll have a meeting, and it's like that's just so inefficient.
Yeah,
it's like if there's something I can do better, And if there's something which can create more results quicker, then I'd rather you tell me and I'd make the change.
Yeah, it's a quicker learning curve, quicker progression.
Right.
So what with fundamentals, I mean, it takes a long time. I think one of the main reasons people don't really focus on it is because it's not just like understanding some patterns, is it? There's a lot more to it than that.
Yeah.
How long have you been an analyst, for instance?
Yeah. I mean, so I think this summer, this will be 14 years. And it definitely is a bit of a blessing of fire when you're looking at fundamentals. At the beginning, I mean, my background, I mean, that you and I have known each other for a while, but for the benefit of the audience, my background is I didn't come into the workplace thinking I want to work in financial markets. I kind of fell into it in a certain way because of Big Brother in that sense. So I was given an opportunity that then resulted in the beginning of my career. But yeah, so you kind of... you go through a period of, there's a lot to learn, but the key is structure. And I think that's the most important thing for a retail trader, is when you look at news, and the reason why most people avoid it from a non-professional sense is because it is very difficult to trade the news. And the problem I always see is with retail traders, a lot of them, they'll go back and look at, say, non-farm payrolls, and they'll look back in hindsight with a little touch of FOMO, and they'll mark up their chart and go, oh, I could have made X or Y. But the reality is that what I try and stress to a lot of the new traders that I work with is that that's probably the worst scenario for you to trade, because you don't know what you're looking at. You've never really had to execute in that type of time frame or those types of volatile conditions. And these types of things take time to master, and you need to watch, learn, review, practice, and build to these types of situations.
Totally, and it's not about guessing. You're not guessing the move or the result. You're guessing the market participants' reaction to the result, right? So it's so complex.
I mean, take that's a great point, because actually that leads us into the current environment, say with coronavirus.
Right.
So what's been really interesting is that numbers, let's say, so from a logical or statistical point of view, the amount of confirmed cases in China is north of 70,000. Now, Italy goes from 3 to 150. So let's put this into context. 150 people comparative to 70,000 plus. Now, the market was perfectly cool with 70,000, but it goes to 150 in Italy, the Dow drops 1,000 points, which actually is quite irrational from a factual point of view, because what we're trying to master here in the short term, the fundamentals, is what is people's perceived view about how then, what does this mean for the future? And now it's about, okay, Italy has an outbreak. Well, what about France? What about Germany? What about the southern part of Italy? What about now a full-blown pandemic?
Right.
And so markets trade today's price on future expectations.
Yeah.
So
there's so many variables.
Right. And so with the variables, again, it's another key point, which is, we were talking earlier about the beginning of the year. 2020 has been an amazing year so far. Right. I mean, for many different reasons, but
we started with Iran, right?
Yeah, Iran kicked off at the beginning, and that was, tensions in the Middle East are always never far from kicking off. But that episode came and went, and then the trade deal between Phase 1, US and China, came and went. Now the virus has come. But when was the last time, let's say, you really were hearing a lot about Brexit comparative to 6 months ago? But this is what I mean about fundamentals and applying a structure. Now, we know the Brexit deadline is the end of this year, and there's also another kind of a semi-soft deadline in the summer, at the end of June, when Britain needs to make a decision about, do they want an extension to the transition? That idea of, can we get a trade deal done in a limited amount of time? So right now, it's the virus. And actually, that drives intraday sentiment, short-term sentiment direction, until we get a handle on the impact on the global economy, and also when does it stop? Or does it turn into a pandemic? But that will change. The narrative will change. And then we know, let's say, the milestones of Brexit. Brexit will come up the agenda again. Boris's agenda is to standoffish as a Europe at this point. So a no deal will start to become a new risk for markets. But so if you see what I mean, you can almost time these milestones when the news cycle will peak and trough, and what the subject matter could be. So that will define then where you should focus.
And it's about change. You put a post on Twitter earlier about being able to, you mentioned the junior traders kind of being all shaken up and a little bit kind of exhilarated by what happened in the market and not being able to reset their bias.
Yeah.
But it's really important to be able to do that and kind of analyse each day as it comes, isn't it?
Oh, yeah.
Because it does change. And what we find a lot is the market will do something completely different to what people expect and then immediately go back to where it left off. Right?
Yeah. I mean, a lot of the time, and I guess this is somewhat part of my job, I don't think that people quite understand, is that I'm trying to second guess people's interpretation of news as much as the news in itself.
Yeah.
So this is about markets. You might have read books and it's about how markets are quite irrational. And that's because ultimately what moves asset prices is people like you and I, bigger players in the market, that are making decisions and moving, buying and selling of assets. And so it's this idea of what is it that's going to take for them to change their mind, and this is what big hedge fund managers and stuff will be doing. They'll be thinking about then the bigger picture and the bigger, broader narrative.
How's everyone else thinking?
Right, and that's really key, and that's another thing I get. There's almost like a tipping point with fundamentals where a lot of the analysts on my old desk, they would get to a point of a year or 2 years in, and they would say, "Oh, I've got this now. Like, I've got this whole macro thing. Yeah, I've got it down." The day they did that, the market will always find you and punish you. Complacency is a killer in markets. And so what was always quite key was that you've always got to be mindful that you never really quite control it, but you can only control then the variables at that moment in time, perhaps to then execute a trade or an idea.
And then also guessing what's going to happen, or you think you know what's going to happen, and then actually making money from that is a completely different
I mean, so yesterday was a case in point. People will look back and sometimes moves like yesterday will draw a lot of media attention. I'm not talking about financial press. And this is what can be quite dangerous for new entrants, retail traders to the market, because they'll see Brexit and the brokers are splashing about Brexit, make money out of Brexit, or they will say about the Dow fell 1,000 points the first time in 2 years, and it draws people in. But actually, even though we know the price went from A to B, the direction of that price in a short-term intraday environment is very volatile. It's quite illiquid. Getting a fill on the kind of bid and offer is quite hard. So if you're intraday trading, it's tricky conditions to manage. And like what you said, going into the junior traders into today, whether they made money or lost money, it's almost like it's not a bad thing to take some time away. Maybe take the morning off, just to reset yourself. Go and do what you need to do. And people often ask me, "Like, how do you reset?" And it's like, well, look, you've got to try different things. I mean, over the years, I've seen traders do a lot of different things. They go to the gym, they go for like a crazy 15-mile jog, or they go to the pub. Like, there is no right or wrong answer here.
No, it's really about resetting your ego as well, isn't it, to some degree? Because it's like, oh, I was wrong. Or, oh, that didn't do what I thought it would do.
Right. So, this is another thing. It's like learning to take a loss is the absolute 101. It's all part of the course of being consistent. And that's why you hear these phrases like discipline and having a process and being, sticking to that. And it's kind of, that is key.
Yeah, a loss should be nothing other than a business expense. Like, if you've got a trading business, you're going to have losses, and that loss is just a cost of doing business.
But I think with that, what I see, because the people who do a lot of our training come from a variety of different backgrounds. Right. Quite often what I see is that, and this is slightly generalising, but young people are a little bit more adaptable perhaps because maybe they have naivety, they don't really have much idea about risk in a truer sense, they don't have financial or family commitments in the way an older person might. They also, with older people though, what tends to happen is, if you've risen through the corporate ranks, let's say, or you've been a business owner, to then step into an arena where not only is the subject matter a little bit, you're uncertain, but also you're losing now, but you're used to winning. And actually, it's quite an interesting battle.
You know the profit margins on everything that you do.
And it's like, as much as you might understand what you need to do and how you should manage it, there's a difference between knowing what you should do and then actually doing it. you know, as you all know.
Totally. So just before we go on into more subjects, tell us a little bit about your role as, because you mentioned earlier, kind of like a quarterback for the traders. Talk to us about the whole kind of setup there.
Yeah, so what would happen normally is that with the fundamentals, there is quite a lot to understand and to interpret. And so a lot of traders traditionally would rely on someone like me to break that down and for them to be aware of. So like this morning when I was briefing our traders, the question what I'm trying to relay to them is, well, what needs to happen as the next trigger point to then lead to a secondary sell-off? Because if you think about it, if now perception has caused an equity collapse to X level, this means now that some degree of negativity is priced in. Now the question is, well, what needs to happen to take it to the next level, if you like? So there it's about constructing these kind of scenarios, I'd say, and that's where I do a lot of the work with the traders, and it's thinking ahead of time and thinking about, okay, it's like a game of chess in my mind. It's like, okay, if I move this pawn here, what's then the next move and the move thereafter? And so therefore that might not happen, but this might happen. And then I have like a hierarchy of scenarios, and I try to relay this to the traders so that actually when they're trading, it becomes much more binary, where they feel quite in control and they've got mental confidence to be able to manage what can be quite volatile, unpredictable conditions in a much more, well, I've already planned for this. I already know my entry point, my exit, how I'm going to manage these trades. But that's where a lot of people will not do that preparation correctly. And so they will go and wing it. And as you know in life, if you try to wing things, that might happen, you might get lucky every now and again. But it won't give you consistency probably that you're looking for.
No, totally. But you mentioned earlier as well that there can be times where you can have access to all of the news resources in the world and still quite not know what's going to happen.
And this is a very common question that I get. And to explain the process of that in the most simplest fashion is, as we just mentioned, there's been three real key, let's say, top-level macro themes: Iran, China, US, and now the virus. So what I try to do to our traders is explain to them this idea of a hierarchy. Kind of think of it like a pyramid. And what we have here are these little blocks, and each block, in my mind, it will represent, let's say, an individual topic. Now this could be Greece, could be Italian politics, could be Spain, Iran, and so on. Now what's important here is, if we take Greece, for example, Greece right now, as far as global asset prices are concerned, particularly in the context of yesterday and the virus, it doesn't matter. Like, that's no offence to Greek people or the land of Greece, but it doesn't really factor in as to what's moving the euro, for example, right now, even though it is part of the Eurozone. So the key is to start eliminating unnecessary of these blocks. Have quite a small number of blocks that you order then into a hierarchy of which there will be one dominant theme. When you have that dominant theme, that's the thing you need to be a master of. You need to be a black belt in all things to do with coronavirus. As in, who's making the drugs? How quickly could it come to market? What's the next country susceptible to getting the virus? How quickly are the numbers escalating in Italy? How quickly is production returning in China? So again, it's like, it sounds like a lot, but it's all about one singular topic. So then it's about, that's the key thing. Don't worry about the rest.
Process of elimination.
Exactly. And so then it's manageable. Because then when you're looking at the news, you actually look at Bloomberg and you think, no. Yes, that's what I need. And you can overlay that then when you watch Bloomberg TV. Like, if I was to ask anyone in the audience now, turn on Bloomberg TV, I can tell you what they're talking about as of today. Talking about virus.
Coronavirus,
So they're almost spoon-feeding you then. And what's good about something like that is not that I specifically listen to what Goldman Sachs are saying, but remember what we said earlier, it's about what the herd think. It's their perception. Now, how do I answer that? What do they think? Well, I listen to the guy at Goldman's, and then I listen to the guy at Citi and Barclays and HSBC, and I'm no rocket scientist. All I am is an aggregator of information. But I know what to aggregate. And then I take all these little elements, and then I form what is a constructed view, and then the key elements then that could be trading almost signals from a news point of view. So that's the process. But yeah, it's easier probably said than done. It requires a bit of practice. And
So talking about Bloomberg then,
yep.
what about what we normally find is that there's certain news or a certain angle to different events that they take because they know it's going to cause kind of a bit more of a reaction. So do you find that there's a difference between positive or negative news?
So my previous job, certainly I had quite a close alignment with, say, Bloomberg and Reuters, these other news agencies, and definitely news agencies are there to sell a product, a service, a terminal system in the case of those guys. And so, sensationalizing headlines is part of the course.
Yeah.
And actually then for retail traders, this can be quite difficult when you're not perhaps that knowledgeable about markets in general, because when they start talking about this virus like they might be doing today, don't forget that's happened.
Yeah, right.
What a lot of new people will come in, they'll read the Times or the Telegraph and they'll be like, stock market's collapsed the most in 2 years. Then they'll be like, right, I need to go and trade.
Yeah.
And you're like, you've missed the move now, or the big bulk of the move. And so there is a distinct difference between what markets look at and I think what, not just Bloomberg, generally media pushes.
Yeah.
Particularly Brexit, for example.
Yeah.
I mean, it's very hard to have even a conversation outside of markets with people about Brexit without people becoming angry or agitated or whatever.
Totally.
So when you trade that, then people definitely are trading their view, which is bad. Because generally you've got to look at the market, you have to look at the market objectively. I mean, I give a briefing to our traders and I share it on YouTube, and it's quite funny, the odd comments that you get, because I talk about markets like, let's say, Mark Carney would, which is I talk about the economic implications of Brexit, but then people think that you're anti-Brexit or you hate Boris Johnson.
But it's really objective, eh?
But it's just talking about the economics of what would happen. And, so these are very important things. A good example of that was when the Bank of England released a report about originally Brexit many months ago, and the newspapers then ran the headline story the next day: unemployment 10%, house pricing crash of 30%, and it was like the whole economy is going to suffer 8%. And it was like, when I read it, I go, hang about, they're quoting the Bank of England's stress test report, which was one of multiple scenarios in which the papers have decided to pick the most unlikely, economically adverse scenario that the model runs.
All of the ones they could have picked.
So basically it's the one that's the least likely to happen, but it's the one that sells the most newspapers.
Yeah.
So you've got to be careful with that for sure.
Yeah.
And newspapers, national newspapers, regardless of country, have very clear alignments with generally the right and the left.
Yeah.
So whether it's the Guardian or the Telegraph or the Times, they do have the same story but a different spin.
Different angle, yeah.
And so how do you counteract that? Well, two things. One, try to read around and open your mind. You probably know about like echo chambers on social media, and you break that, because you need to know the alternate argument. It's healthy to know, let's say I'm pro-Remain, it's important that I understand why people voted for Brexit, because it helps me then formulate a better constructed view of what might happen.
Yeah.
So you've got to, again, it's like the ego thing with managing loss. It's like an ego thing with getting over the fact that you might think that you're always right. It's not about that.
No.
It's about the merit of what is it, subject, the variables you're looking at.
Yeah. Okay, so you mentioned non-farm payroll, NFP. Tell us a little bit about that in your experience, because many people get excited and think that they should trade that. I found personally that maybe a couple of years ago it had a lot more of volatility during non-farms than it does today in the Forex markets anyway. What are your kind of views and insights around non-farms? Firstly, explain a bit about what it is for the people listening.
So non-farm payrolls is kind of the traditional main economic data that comes out of the world's biggest economy. So it's basically jobs in America created month to month, Xing out farming jobs, which would be impacted by seasonality, for weather and planting of soft agricultural goods. So if you know the unemployment situation of economy, then the economics would suggest then you've got a pretty good feel for generally how an economy is going to perform in the future. And so that's why historically it is important. Now, that's what I mean though. Historically it was important. If you've got to look at everything in context. If you think about right now, if you're the US central bank and you're trying to make a decision about future monetary policy, if I was to pick up the phone and speak to the head of the Fed this afternoon, the main thing that he will be most interested in is the virus.
Right.
About trying to quantify the impact that might have on the US and global economy, and does he and his team need to make any actions? So when we start looking at unemployment rates, it's does it really matter?
Does it matter?
Because actually unemployment in America is spectacularly low at the moment, record low.
Right.
Job creation has its fluctuation in non-farm payrolls, but ultimately it's not a big issue for the US economy right now. Now that's not to say it won't be in the future, but right now it isn't. And so what makes their non-farm payrolls potentially more market moving is when the employment situation is key. So if you go back to 2009, 2010, right in the depths and then recovery of the financial crisis, then it's about jobs is key. Because unemployment rocketed. People making benefit claims, and jobs data is pivotal as well as housing data. Whereas time evolves. And so with non-farm payrolls, it's one of those where if you're a new trader, high volatility, although you can make more money, you can lose more money.
Right.
And actually, if you're new, what you're trying to aim for, I feel, is consistency. And so if you can learn to avert excess volatility, you probably will find that until you then have watched multiple non-farm payrolls, then you'll be more equipped to be able to tackle it. But my key kind of thing I would say is, if you're going to trade data, then know what the data is, then look at it, prepare for it, build strategies, scenarios, execute on a sim, then review, and then do again, and then again, and then start with small size. And you're picking probably a world which is built for high frequency robotic trading. So why compete with the machines when you have benefits as a human, which is your ability to be able to perceive sentiment, your ability to be able to find maybe opportunity or patterns that perhaps aren't, standard systems might not pick up. So
I don't trade it. Like I literally don't trade that day. I've got no interest in trading it either.
I mean, a good saying is, if you're on a main trading floor, if there's someone trading at 3 p.m. on the day of non-farm payrolls, they've had a bad day. Because basically what that means is they're reaching. They've basically lost money.
They're revenging.
It's Friday afternoon, and they're there at 5 p.m. like this, hunched over the screens, thinking, "I've got to get my money back." And then think about, you know this as well. Being a trader is like, think about the mental state that you go into the weekend in, which is your time. And that switch off becomes so much harder. It's so important to manage the losses in that sense, to manage yourself in that way.
So let's talk a bit about the virus then. Let's talk about the coronavirus, because this is kind of current news, and you've been doing a lot of research and work yourself on that. What's happening?
So I mean, I write like a piece every Sunday that I put out.
It's great.
And basically I try to make it as short and concise and as kind of clear as possible. And I had kind of a 3 bullet point thing I was looking at on Sunday. My routine is on a Sunday, I basically don't look at markets. I try not to at all on Saturday. And most of Sunday, that's kind of family time, and so on. But on Sunday night, I spend a good 2-3 hours reviewing the news. I go through the calendar. I start visualizing like a roadmap of what I think the week is going to entail. Now, just because I look at the markets fundamentally, I absolutely do not ignore technicals. So I spend just equal amount of time looking on a higher time frame, maybe a daily, is looking at where are we in the bigger picture of things, because I need to overlay then in where could the potential catalyst come that could create the movement within these prices.
Do you look at the dailies or the weeklies?
Yes, I'll be aware of big weekly levels. Like in the euro, there's an amazing trend line going all the way back to the inception of the euro right now at the moment, which we recently bounced off at around the 108 kind of area. And so everyone's aware of these bigger levels. I generally will look at a daily and then look at the picture over that time frame. And then it's about, well, what could be a disruptor to that technical setup of what the pattern is looking like at that point in time. So it doesn't need to be that the news is, say, I'm trading the news in the purest sense, because you've got to be pretty in tune and a finger on a pulse to do that.
Definitely.
And unless you're in a professional environment, it's quite
retail
difficult.
Traders, it's very rare.
So use the news in a different way. Use the news then as a reason to give you bias towards market direction. Like if you look at the euro-dollar pair at the moment, generally it's been trending lower. Now, if you look at the American economy against the European economy, economically, it's quite clear there's a divergence. Germany is really suffering at the moment.
Yeah.
Their manufacturing is in contraction, heavily so. Whereas in America, the data in the last few weeks has been great.
Yeah.
So actually then, the fundamentals for dollar are stronger, for the euro is negative. So euro dollar is just a nice trend. You've got a technical trend, and you've got a fundamental bias for direction.
Yeah.
So that's still how you can use the news in that sense. So what I try to do with, say, the virus is like what I did at the weekend, break it into 3 definable parts. One is then monitoring the numbers of the spread of the virus outside of mainland China. It's all been literally 97% contained in China.
Yeah.
And as long as that, I know that sounds bad, but again, this is objectifying the news from an analytical point of view.
Sure,
I know people find this quite hard sometimes when they hear me talk about it, but you know, I know people are unwell and people are dying, but the fact of the matter is, as far as it being contained in China, then the markets are okay with that.
Yeah.
It's about the cross-contamination over different borders that would cause a full-blown potential issue.
Yeah.
Because if you think about it, if you do like in China, they lock down travel, they lock down, people can't go to factories. This then leads to point 2, which is if you think about all the products that we consume and we sell in mainland Europe, for example, it all comes with component parts that are manufactured in China. Now, if the Chinese factories are shut, that's problematic for the supply chain, which will then impact the performance of Europe as well. So here then it's about the spread of the numbers and tracking that outside, and Italy was the trigger point this week, and now it's about where else and how far does it go in Italy. Then it's about the supply chain impact, the real tangible impact that it's having on the data. Then the third one's the key one, and the third one's what happened yesterday, which is fear. Pure, unadulterated fear.
Right.
Fear of, oh my God, what's happening next?
Yeah.
And if fear leads to selling, and people see selling, that leads other people now into joining that momentum trade, and then it almost snowballs and it almost manifests itself.
And yesterday was the 24th of February, 2020, for those of you who want to go back and see what happened here.
Yeah, so if you watch the briefing that I did on that morning on the Amplify YouTube channel, go to the briefing that morning before the sell-off, and you'll see just what we were looking at as part of our kind of scenario building that I talk about. And then you'll see that this isn't about being right or wrong, but you can see about the process of how I got to the conclusion that this week could be the moment when it happens. Another real clear thing that happened that helped create the fear is if you look at the economic calendar, I talk about that week. So when I wrote that piece on Sunday, I was thinking, well, the market's really susceptible Monday, Tuesday, Wednesday. Why? Because if you look at the economic calendar of when speakers are happening, when the corporate earnings are happening, all this type of scheduled news, it's Thursday and Friday.
Right.
So for me, that means that the way traders tend to operate in the speculative short-term environment, they always focus on the matter at hand. And if there's no other distractions, all the more self-fulfilling that one singular subject becomes. And that hierarchy is so dominated by that one subject that the market goes with it. And I think that's what we had on Monday.
So how does talking on the subject of kind of analysing news then, what about things like Trump? Because you mentioned Twitter earlier and the fact that social media is so instant. I mean, Twitter feeds can be as good as some of when we were talking about trading back in the day. I mean, you can get Twitter updates quicker than you can get some.
Absolutely.
It's just as good
now.
So what happens in that realm? What happens when Trump tweets, and how do you handle that? How do you prepare for it?
I mean,
and what's going on in general? Like, what are people thinking?
So Twitter is a really crucial system that we use, even as professionals in that sense. But as a retail trader, it can be massively useful because it's not about capturing. Again, it's not always about capturing that piece of news to then action a trade. It's about developing your understanding of markets. How do you know this stuff about the virus? Actually, all I do is I open myself up to seeing lots of little stats, little headlines here and there.
Yeah.
And the only thing I'm very good at, I guess, is over the years I can maintain. I've got quite a sponge brain where I can remember things and absorb it and remember things.
Yeah.
And so, but that didn't happen itself straight away.
No.
But when you have Twitter and the beauty there is you can curate your own feed. So if you follow the right people, it's quite a powerful resource where they're adding value to you. And so when you're looking on your phone, it's like, oh, okay, yeah, so I get the insight of what this guy thinks, what they're saying, what Goldman's is saying. Like I was saying before, remember, it's important to look at all the views and make your own. So when it comes to then the more sharp end of the sword, which is monitoring it for using it, like with Trump. So one of the things I did when Trump first became president was mapping then his actual behavioural pattern of how and when and what he was tweeting.
Right.
Now, one thing that I guess retail traders can be quite guilty of sometimes is they always react. They're always reacting.
Yep.
Now, if you react to news, you will lose money.
Of course.
Like, you have to be proactive. So here, what I would do is if there's a meaningful way where something is moving the market, so in this case, Trump, it's about then thinking forward and thinking, okay, is there a pattern? Does he have a strategy of how he uses this medium for his benefit? And actually, there's a quite clear, distinct pattern of what he does. And if you start looking at things like his travel plans, so say this week in particular, he's in India today, he's giving a speech. And so actually then I need to define the parameters of the time zone. So if he's in India, okay, his tweets change in terms of the times at which they come. It's all very straightforward, logical stuff, but people generally don't have the ability to think laterally when it comes to news, I think. And that's just one skill, I guess, over time that I've kind of honed. And so with Trump then, it's about when could he tweet more? Well, if you look about when he was getting, when it was in the Senate and the House and this whole impeachment thing, you actually see him tweet, his frequency of tweets goes up almost exponential. And all of this is about, distraction and the witch hunt and all these other things. So then it's about, well, what's happening on the Trump political timeline? And how then, where is the stock market? And does he need to manage things in order to, we know that obviously he loves talking about the stock market's on record highs.
Yeah, he's very hyperbole, isn't he?
Right, so he last night he tweeted saying, oh, it's okay. The stock market will come back. Don't worry, this sort of thing. Yeah. And actually, you can anticipate his responses. And if you actually looked at oil prices, I've actually got quite detailed data where there's a real sweet spot where we get to $65, $68 on the upside and $42 on the downside, 44, 42. And you could pretty much plot Trump's tweets about specifically oil and Saudi Arabia and Russia around these extremities of price. Too high, bad for the US consumer because the prices at the pump go up and that's bad in an electoral year. Right. And so he wants to be popular in those types of things. And then too low, well then all these shale producers in America, which are leveraged up massively to take advantage of this massive boom in production, well, they've got that on borrowing money. And so if the price starts going south, big problem, and all these credit spreads and these companies starts blowing up, and he doesn't want mass unemployment either. No. So when it gets up here, he puts the pressure on Saudi, you need to pump more, because then the price will come back down. It comes back down here, he then tweets and says, actually, I quite like China, and we're going to cut a great deal. And what happens then? Well, markets come back up again. So you can predict to a certain extent these things. And so this is what I try to encourage our guys to do. And that's why trading effectively with the fundamentals takes a lot of legwork. Yeah. And that's why I think a lot of people are intimidated to do it in the first place. Because there could be days, I'm sure you're the same, looking at the way you trade, is that there might be a day where the best choice is not to trade. Mm. And you might take a bit of time coming to that conclusion. But that's not wasted time. Oh, no. That's actually saved you. That's actually probably made you money by not losing money.
Of course, yeah. Yeah, there's certainly days where I don't trade. And Anthony's my analyst. I just check his stuff out and he's got my back. No, but there's certainly days where I'm like, I don't trade, and I appreciate what that has earned me in the long run. Because if I did trade and then I lost money, and then and the worst thing you can do is actually win money on the days you shouldn't be trading, because then you get this kind of cockiness.
The siege is in.
And then it's like, right, now I know what the market's going to do, and that can be just as bad as taking a loss. It really is. Yeah. So what resources then? We're talking about Twitter. What resources are good on Twitter for some of the retail traders if they're looking at following some fundamentals? Yeah. Other than yours, which all of your details will be below the video.
Well, the shortcut to get things off the ground is go on mine and follow people who I follow. Right. That will give you a good starting point of a nice kind of mix of people talking about things that are big top level macro kind of general news. And then really it's down to you as an individual and what you trade, what products you focus on. And what I typically do is every month I'll go through the process of spending a couple of hours refreshing, having a look, is there anyone new that's tweeting? Is there anyone who's not adding value to my Twitter feed, for example?
Yep.
And so what I don't want is it clogged up with irrelevant information.
No,
Everyone must be offering me value.
Yep.
And so therefore, like I said, there's a variety of people I follow who are individuals. Some are analysts, some are traders, some are actual big firms, for example, that put out and publish insightful infographics and things like that. So they're the main things. There are some podcasts. Barclays do a great one. It's called Word on the Street. I think they'd have it on Spotify and things like that. It's a 15-minute podcast with their chief investment officer. I know that sounds really dull, but actually, again, it's about understanding. Here's a guy with 25, 30 years experience in the market. He's managing multiple billions of pounds in the market. I want to know what he thinks about the virus. Right. And so, because trading is one element. There's also investing, which are kind of two separate things. And so the investment part can be very useful of like, okay, what's the bigger long-term picture?
Yeah, totally.
Yeah, and how do we take advantage of right now, perhaps for the long term, rather than just the speculative short term?
Yeah,
in that sense.
All right, so for the people watching, instead of going and do 3 years in university and going to study the markets for 2 years and then kind of develop all of that insight, what's a kind of quick routine or a structured way of consistently applying fundamental analysis to their trading?
Yeah, so I think the most pivotal part of the day for me is early in the morning. So what I try to work with our traders with at Amplify is they shouldn't be placing a trade. Bearing in mind we are a global macro trading firm, so it's very different from trading, say, a single stock where I'm looking at the balance sheet or metrics of a company, and its P&L, its product mix, and these sort of things. So we're looking at the bigger picture. And so then it's about, well, before you even place a trade, what is the news flow at that point in time? Remember we talked about objectively reviewing and reanalyzing every day on the merit and the variables at play for that session. Every session has a different calendar. Market pricing is built in a different kind of perception of where we're at with these certain stories, and spend some time then looking through kind of Twitter or Bloomberg, the FT, these sorts of things. And when I say go through those websites, I don't mean I go through them in the morning. Granted, I know what I'm looking for, but I'd say it takes me 10 minutes to look through Reuters, Bloomberg, and the FT to pick out maybe 3 stories. Yeah. But they're the 3. It's not about the 300. No. It's not more is more. It's less is more. It's being selective. So that's where you do need to develop your understanding of, okay, the most simplest one would be if it's UK monetary policy, it's like, well, who are the people that make these decisions? Because therefore they're the people's comments who you need to listen out for, rather than listening to every person. Just as an example. So I'd spend the first part of the day looking at that, applying that structure we spoke about, understanding then the scenarios of how the day might play out with that daily calendar of events that is going to happen. There's also thinking about the UK European Open, the data that comes out, and then what I call kind of the crossover. At kind of 11 a.m. time, where if you think about
in the UK.
Right, in the UK. So this is the same time as then if I'm in New York or Chicago, I'm coming to work. And they're doing the same as what we're doing. And so then there's that transition period where this is quite common actually back in the sovereign crisis in Greece, Ireland, Portugal, getting bailouts. Europe would fall. The Americans would come in, but the American economy was okay. So what happened was markets fell in the morning, the Americans came in, better price to buy again, and the markets did a perfect V-shape. Only until blood was spilled outside the Greek parliament and it really blew up. Then the Americans started selling the story, then the whole thing just went the way it did at the time. So first thing in the morning. Then it's about, when you look at non-farm payrolls, so every day might have some important economic data. So you've got to think then about your trade strategies. If you've got a really sound technical setup for a trade, also ask yourself the question about timing. It's about, okay, so if US retail sales is coming out 1:30 p.m. London time, so when I'm in that trade, can I be in a trade and out of the trade in order to close it before exposing myself to an unnecessary amount of volatility? Or am I best to wait, let the data come out, avoid that excessive risk, let's wait till Wall Street opens when the volume picks up, and perhaps then if that technical setup still applies, I'll take the trade during US North American hours. And again, as a retail trader, what I think you should be aiming for is that, you know, you don't need to be like me. You don't need to be a slave to the screen. Like you can pick and choose, and you should reanalyze your data about where you operate best and focus on that. So if, I know plenty of good traders who come into work literally at midday or trade the US session, but they will be looking at the market quite late at night for the close as well. And so you find, I saw you the other night, you were up looking at the Aussie at like 4 a.m. in the morning.
Yeah, right, because we had some news out.
Right, the best opportunities can come, but you know the products that you excel in. But that definitely comes, and you mentioned this before to me, before we started this session, was about cataloguing your ideas, whether you placed a trade or not, and then responding to your metrics. That's so key. If you don't do that, if you don't have that diligent process of note-taking and improving, and the improvement never really stops. I mean, the psychological aspect is continuous. I mean, your skills generally and your intuition will get better. But even the best traders are still always re-evaluating what they're doing. Could they do it better?
I think as soon as you develop an edge, the edge is deteriorating, and it takes it's a continuous effort to refine that edge and stay on top of it. And you've mentioned some of the thing we've taken out of this video is your studies of Trump's behaviour and studies of certain things that are just something that you need to study and analyse and apply to your trading, because if you stop, you're losing your edge. Like your edge is deteriorating.
So absolutely. I mean, I'm always thinking about the next potential thing. You know, so like I said, when you look at that roadmap, we talk about Trump. Obviously, there's a US election in November. So the US election fever will come in time. And we will look, I would say, by the summer, and we will say, what virus?
Right.
And
totally.
but that's, you know, and this is why, you know, it's very important to have that foresight then, because right now the virus is king, let's say as of late February of 2020, but if this will change periodically, and you know, being adaptable to that change as well is quite key.
All right, so we're going to do just some Q&As from the social media, but before we do that, what's your advice to anyone who's just looking to trade fundamentals? Like, they don't believe in technicals, they just want to trade fundamentals.
If you were just trading fundamentals, I would say you're going to lose money. Because at the end of the day, it's a good question, because most of the people I'd say that I encounter from retail traders that learn to trade, even after spending, say, weeks or months with me, very few really switch on and become like a 50-50 technical fundamentals. Most still stick to the technicals. That's where they feel most comfortable. That's where they excel. The difference then is about an appreciation about, okay, where are the risks associated with the fundamentals? What are the fundamentals doing that might then disrupt this trade strategy that's technically based? And so that's fine. From a fundamental perspective, I could have the best view in the world, but that's fine. That gives me a direction, and I might be right every time of where the pound or the FTSE might go. But at the end of the day, how do I construct then the best price to enter and exit the market and quantify my risk I'm taking? That must be done through technicals. So it's about a combination of two, and I'm not here as a fundamental person to force it down people's throats. It's more about being aware of it. It can almost be that, you know, if you can add that 1%, if you like, to your performance, that could be then the 51% that puts you over the line. That totally revolutionizes your performance.
Absolutely.
You know, so
all right, so I'm sure you got a lot of value from this video so far. I think it's been really valuable, and what we're going to do now is just do some Q&A from some social media questions that we put out on Instagram this morning. First one is, how do you think coronavirus will continue to affect the S&P, the NASDAQ and the Dow?
So I would say, as what we covered in the video about monitoring the steps that happen here on after. So what I mean by this is, Italy, how quickly do the numbers continue to rise or not? Does it spread to other neighbouring countries or not? Do the numbers in America, for example, which would be absolutely key, do those numbers start to explode or not? So they're the keys to really understand, I think, whether this correction that happened on Monday, the 24th, is going to have a further legs to it. And then don't forget the technicals as well.
Yeah.
You know, there are some real key technicals in the Dow and a trend line in the S&P at the moment, which are equally as important.
Totally. And that brings us on. The next question is, can price action patterns prior to news release give an indication of the outcome?
Prior to the release, people often have this.
I think what they're really talking about is kind of anticipation. Maybe
Right, so what they're talking about is what I would call kind of pre-positioning.
Yeah.
So let's say if everyone thought something very negative was going to happen, then actually that's priced into the pound about Brexit. So therefore, when something bad happens, the actual reaction is net neutral. Nothing happens.
Doesn't matter.
So the key here is not about the market's not going to react. Then it's about, well, if you know the pre-positioning, and let's say it's very negative, you know the current expectation of markets. Then it's about, well, what does this then come out at? And this is your reference point. Yeah. Kind of like a piece of data. GDP is expected at 2%. This is almost like your 2%. So then it's about, well, what if it comes in at 4%? What if it comes in at 0? And therefore, what would I do accordingly? So it's not about second guessing it. And it's not about saying, I think the market's going to bounce or not. It's about then thinking, okay, what would I do in this scenario or that scenario? Is how I'd kind of summarize it.
Okay, we've got a really good question here. Is there any way to quantify or score fundamentals for the impact they'll have in a given market?
Yeah.
So how to quantify the impact of a move?
People often ask me this, and because you can do a lot of back testing now with programming and things like that. The problem you have is context. Yeah. So if you look at data over time, that's fine. Let's say if I go back, people say maybe it's a bad example because it gets a little bit more about fixed income, but this whole where yields are trading or the inversion of the yield curve, which is basically a signal that tells us where bond markets are trading when a recession might happen in future. Now, what's key with this is people often say, well, this has happened and repeated performance through every period of every economic downturn since the Second World War. Yep. However, we've never had zero interest rate policy. We've never had quantitative easing. We're in an unprecedented era. So will history repeat itself? It might, but you have to understand that now is different, uniquely different in terms of the forces that drive markets. Right. So I think trying to quantify a score to things is a little bit, in a way, difficult because, again, remember this pre-positioning notion is different in every scenario. So what happens on a Monday might not be relevant on Tuesday, might be different on a Friday. So the scoring system, unless you had, and if you do, please let me know, if you had an AI system that was self-learning and adaptable to many different variables, which, as far as I know, hasn't been achieved yet, then I don't think you could really look at the world like that. I'd kind of say, well, that's my answer.
All right, so we pretty much answered all of the rest of the questions that I've got here in the video. If you do have any more questions on this, please comment below the video. Make sure you engage. Get this conversation going below the video. Yeah. And myself and Anthony will keep checking frequently the comments and messages down there, and we'll get a conversation going, get people more aware about fundamentals and how they play a role in trading. Before we head out, firstly, I want to talk about the Vault. So we're running the Trader Vault in April the 24th in Amsterdam. And myself and Anthony are going to be there with a panel of phenomenal minds and phenomenal traders across the globe. So Mike Bellafiore, one of them, Siam Kidd, all the rest of them, the guys that came last year. And if you think this was valuable, this one conversation was valuable, that really is going to be unmissable. It's an entire evening of all of the insights from prop firms to technicals to news, fundamentals, and it's definitely going to be one not to miss. You can grab a ticket for that. There's still tickets left that if you're watching this at the time of this recording is 25th of February. Grab a ticket and we'll see you there. Where can they find you, Anthony? Tell us a little bit about what you're up to and how they can find you and learn more about what you're doing.
So again, the firm I work for is called Amplify Trading. So we are a small proprietary trading firm. We also have training that we have online and also in-house, where we have an office, a trading floor in the city, so just by the Bank of England.
In London.
Check out that. You can reach me on Twitter. If there's any questions, people often fire them to me on that. Otherwise, probably the most useful, and it's a free thing that we do, is every morning I give our traders a market briefing where I explain all of the things I've spoken about and about what's relevant for each morning. So like a Monday with the big sell-off, it was could have been useful for people, I'm sure. So that goes on our Amplify Trading YouTube channel, so you can check that out. And again, like with this video, and all of the videos that I'm sure Jason's the same, is that I'd absolutely love to engage with people. If people have questions, absolutely I'll give a reply to everyone.
Yeah.
Because the more that people can share and learn from each other's experience, the better for it. So
very cool. Well, thanks for coming on again, mate.
Yeah, no
Good
worries.
to see you.
You too.
And enjoy.